What's up, traders? So today I'm going to show you how I plan on forcing the stock market to pay for my Super Bowl tickets via options trading. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from the stock market. And I use the money I make from trading in order to pay for my entire lifestyle. Now, I am hoping that this video does not age poorly. And here's the reason. I am a die-hard Baltimore Ravens fan. And as of the day of this recording, we are still in the playoffs and still in the hunt for the Super Bowl. However, in 2 days, we play the Buffalo Bills, and if we win that game, then we'll play either the Chiefs or the Houston Texans next. So we still have a long road to get there. However, I believe we can get it done. But I've been a diehard Baltimore Ravens fan basically my entire life, and we've made it to the Super Bowl twice before. Once after the 2000 season, which I was only 11 years old, so couldn't have gone to the Super Bowl then. And then the second time after the 2012 season, which I was too broke to be within 50 miles of a Super Bowl. And so now if we make it this year, it seems like the perfect time to go because I don't know if this will happen again, if we make it at all. And it's in New Orleans, so I definitely need to get me a shrimp po' boy, some gator, and some seafood gumbo. But this is part of my basement here, so you can see all of the Ravens artwork. So yeah, if they make it to the Super Bowl, that would mean a whole lot to me. But here's the thing, as of this date, if we look here, the cheapest price for a Super Bowl ticket is $6,603. So I brought up the idea of going to the game to my wife and she immediately said, I'm not letting you pay those prices. And when she said it, I was like, huh? And she then repeated herself even more firmly, said, I'm not gonna let you pay those prices. And I said, And then the idea immediately popped in my head, well, what if I don't pay those prices? What if I bring in an additional $6,603 from today's date until the Super Bowl date? Then I've effectively forced the stock market to pay for my ticket. And I think that will work because once I've made that extra money, well, it should all make sense. And as of today's date, the Super Bowl is exactly 3 weeks away. And since I usually bring in anywhere between $7,000 to $10,000 per week, I know that if I break down this additional $6,600 that I need to make, that is about $2,200 per week until the Super Bowl. So I'm going to show you exactly how I plan on doing that. But please, before we get started, make sure to hit that like and subscribe button. It takes a lot for me to make these videos because I am horrible in front of a camera. So if you could do that for me, it would be greatly appreciated. But with that, let's get down to business. So the way that I plan on generating that extra income is I'm going to sell puts. Now, if you're already experienced with selling puts, make sure you stay till the end of the video because I'm going to show you a better way to go about it. But if you're new to options trading, when you sell a put, you have two objectives in mind. You either one, want to generate income, and or two, you want to buy a stock at a cheaper price than what it's selling for today. And the easiest way for me to explain selling puts is to compare it to selling car insurance. Now, if you have a car, you likely have car insurance. And the only reason that you have car insurance is because you're fearful that you could drive and get into a car crash. And if you do, you want to force the car insurance company to pay for your expenses. Well, selling a put is very similar, except when you sell a put, you are the car insurance company. And instead of insuring a car, you're insuring a stock. And here's how that will work. Us as the put sellers, aka the car insurance company, will come over to the put buyers and say, hey, you have ABC stock that is currently trading for $100. And I would like to buy it at $80. So if ABC stock were to crash and drop below $80, I will buy the shares from you. But for doing so, you have to pay me $200 right here, right now. And oh, this contract is only good for another 2 weeks. And so once you've made that contract, here's what happens. If ABC stock were to stay above that $80 contract that you put forth, you just keep that $200 you received and you go about your day. However, if ABC stock were to drop below the $80 strike that you set, then you still keep the $200. However, now you need to buy 100 shares of ABC stock at $80, which can still be a good thing because we only want to do this strategy on stocks that we would actually like to buy at a cheaper price. So you either one, get paid just to wait around if ABC stock stays above $80, or you get paid to buy a stock at a cheaper price than what it was trading for when you first looked at it. So really, it's a win-win. So that is the option strategy that I'm going to use. But now since I need to make even more money than what I typically make, I'm going to utilize leveraged ETFs. Now, if you're not familiar with leveraged ETFs, it is simply an ETF that follows either a specific stock or sector, and it looks to 2x or 3x their daily move. And so here's an example. If there's a leveraged ETF that follows Apple stock, if Apple stock were to move up 1% for the day, then the leveraged ETF will look to move up 2 or 3% for the day. And the same works in reverse. If Apple stock were to move down 1% for the day, then the leveraged ETF will look to move down 2 or 3% for the day. And here's why I like that as an option seller. The more volatile a stock is, aka the more that the stock moves, the higher their premiums are, the more money I collect up front. But now that we have that information, let's go look for the best stocks to trade in order for me to bring in the extra $6,600 within the next 3 weeks. But here I am at an online screener, and I want to search for stocks with high implied volatility. And again, that just means that they're expected to move a lot, and that means that their option premiums are higher. All right, so I have implied volatility set to above 50%, and the last stock price to be at least $10. And I only like trading larger companies, so I put their market cap at least $30 billion. So that looks good to me, so I'll go ahead and hit see results. And it looks like this screener came up with 20 different companies that fit this criteria. And it's categorized from the largest market cap company to the smallest. And if I look over this list here, I see Tesla is number 1, Palantir number 2, ARM number 3, Shopify number 4. But looking over the entire list, I see 2 companies that I love trading, and that is Tesla and MicroStrategy. And we can see Tesla's implied volatility is 67.65%, and MicroStrategy's volatility is 100%. So knowing that I'm already familiar with these 2 stocks, let's head over to Thinkorswim in order to look at a few data points for us to pick the best strike prices. So here we are at Thinkorswim, and I have Tesla pulled up in the options chain, and we can see it's currently $413. However, what I'm going to do is I'm going to use a leveraged ETF for Tesla, because 1, I want the extra premiums, and 2, typically leveraged ETFs have a lower stock price, which makes it easier to sell puts. And the leveraged ETF for Tesla is ticker symbol TSLL. So I now have that pulled up, and we can see that it's currently $28. Now, I know that the Super Bowl is on February 9th, so I need to select an expiration date that is prior to February 9th. And if we come over here, the date of February 7th is before that, so let's go ahead and select that expiration date. Now, one data point that I always look at are the Bollinger Bands. So the Bollinger Bands are these black lines here, but the Bollinger Bands just aim to show you what range the stock price is expected to stay within. And it's typically about 95% accurate. And so you can see when it pops out of the Bollinger Band, it pops right back in, pops out, goes back in, and so forth and so on. But if we look over here, we can see that the Bollinger Band expects it to stay above a price of $24.25. And so when I'm selling puts, I want to go somewhere near that level. So if we head back over to the options chain, the second data point that I want to look at is the delta. And we can see that the delta column is here. And by definition, delta is how much an options premium will move based on a $1 move in the stock price. So for example, if we looked at this strike here at a $23 strike, it has a delta of 0.20. So that is saying that this options contract should move about 20 cents per $1 move in TSLL. However, most traders use delta as a probability of an event occurring. So if we use the exact same example, at this 0.20 delta, that's saying there's about a 20% chance that TSLL's stock price drops down to this $23 strike price by the expiration date. Or in other words, you would have about an 80% probability of profit with selling puts on this strike. Now, I typically stay below a delta of 0.20. However, I know that I need to make extra money here within the next 3 weeks in order to get these Super Bowl tickets. So I'm going to be a little bit more aggressive. So I'm going to pick a delta anywhere between 0.20 and 0.30. So with that information, it looks like I can select any strike below this $25.50 strike. Now, if we recall back, the Bollinger Band said that it should stay above $24.50. So what I'm going to do is I'm going to come over here to this strike of $24.50, and that will get us to a delta of 0.25. So that is perfect. So what I'm going to do is I'll go ahead and I'll right click, hit sell, and go to single, because this is a single leg options trade. And now that I'm here, I need to select how many contracts I would like to trade. Now remember, every contract, you are agreeing to buy 100 shares of this company if the stock price were to crash below your strike price by the expiration date. So the best thing to do is to do this on a company that you would like to purchase at a lower price. And I like Tesla as a stock, and I'm very bullish on it, so I am fine with selling these puts. Now, we need to select how many contracts we would like to do. For me, I think I'm going to do about 10 contracts. So I'll set it to 10, and the last price that went through for this contract was $2.17. Now, that is the price per share that we will receive. Now, remember, every contract is worth 100 shares. So we will receive 100 times that amount per contract. So I will receive upfront $217 per contract. And since I'm doing 10 contracts, that means I will receive $2,170 for this trade. So that puts me almost a third of the way there. And now let's look at the next stock. But guys, if you like what you see here, make sure to come join the Trade to Freedom community. The link is in the description below. You'll not only get all of my trades as soon as I enter them, but you'll also see my entire options framework via the Trade to Freedom course, and you'll be within a community of people that all have the same goal as you. So if you're interested in learning more from me, click on the link in the description below. Now, the other stock that the screener pulled up was MicroStrategy, and we can see that that stock is currently $367, which I would be fine with trading. However, if you have a smaller account, you may want to utilize one of the leveraged ETFs for MicroStrategy, which you could use MSTU. And we can see that the stock price for that is currently $11. And if we look at MSTU's chart and we look down here at the Bollinger Bands, the lowest Bollinger Band shows $7.95. So it currently expects for it to stay above that price. So let's head back to the options chain and look at our delta. So if we were to go somewhere near that lower Bollinger Band price, that'll put us at the $8 strike. And if we were to sell puts, it looks like the last price that went through was 66 cents. So we would immediately receive $66 per contract that we trade. But if we look, that's only a delta of 0.13. And remember, I want to be a little bit more aggressive than I usually am right now because I need those tickets. And so instead of a strike of $8 and a delta of 0.13, I'm going to go a little bit more aggressive to the strike of $9 at a delta of 0.19. Now with this stock, I'm typically more conservative because MicroStrategy is very volatile within and of itself. And to receive $92 for selling a put at a strike of $9 is a super high return. And so we'll do the exact same thing. I'll right click, go to sell and hit single. And for this, I think I'll do about 20 contracts. So I'll come over here, go to 20. And since we're receiving $92 per contract, if I do 20 contracts, that is $1,840 that I'll receive right here, right now for opening up this trade. Now, all the same rules apply. Make sure that this is a company that you would like to own and that you are bullish on before entering into this trade. And that way, if the stock price drops below your strike price and you are forced to buy the shares, that you are okay with that because then you can sell covered calls, but that's a topic for another video. But now we are nearly 2/3 of the way there. And now I want to do this on a third stock, which I will use ticker symbol SOXL. Now, SOXL is just an ETF that follows the semiconductor industry. So it includes big names like NVIDIA, Broadcom, AMD, and several more. And so it moves very similar to ticker symbol SMH, which also follows the semiconductor industry. However, you can see that this is a 3x leveraged ETF, so it looks to make 3 times the daily move. And if we look at the Bollinger Bands for SOXL, it looks like it currently expects it to stay above $27.17. And if we go all the way back here to November, we can see that it's pretty much just traded in that range of $27 to $31. And so now that we have that information, let's head back to the options chain. And we're still on our expiration date of 21 days out, but the Bollinger Band expects it to stay above $27. And if I look here, is about a 23 delta, which is okay. However, for the next 3 weeks, I need to be a little bit more aggressive to make that extra income. And since SOXL is an ETF with several companies within it, I feel a little bit more comfortable with being more aggressive on this stock. So I'm going to come all the way down here to the strike of $28.50, and that puts us at a delta of 0.29. And the last price that went through was $1.51, which means we will receive $151 per contract. So let's go ahead, hit right click, hit sell, and go to single. Now, we are currently in earnings season, and ticker symbol TSM, which is Taiwan Semi, just had their earnings yesterday. And they had amazing earnings. And they are the largest chip manufacturer in the world. And so if they had great earnings, that is a good sign for other chip companies, which would be a good sign for ticker symbol SOXL. So I think I'm going to go ahead and get the remainder of the money I need from this stock. And doing some simple math, I need about 18 contracts at this premium. So I'll come over here and I'll do 18. And 18 times 151 will give me $2,718. Now, if you have a slightly smaller account, you could turn these short puts into a credit spread. And to do that, we'll still sell the same put. However, we will buy a put at any price lower than our short put. And what it does is it lowers your risk, which in return lowers the amount that you need in your account in order to place the trade. And I'm not going to go into high detail about credit spreads in this video, but if I were to place a credit spread, I could come to that exact same strike of $28.50, right click, hit sell, and go to vertical. And now we just need to select our long strike, aka the put we're going to buy to open. And so I could just come over here and let's say we only want to risk $300 on this trade. Well, I would select a strike price that is $3 less than $28.50, so that will put us at $25.50. So I'll click here, I'll go to $25.50, and now we can see we'll receive about $70 per contract, which is less money. However, we only have $300 at risk. And so if I hit confirm, we can see here that the max profit would be $70. And our max loss is the distance between our strikes times 100, which would be 300, minus the premium we received, which is $70. So that puts our max loss at $230 for this trade. So that is a great strategy for individuals with smaller accounts. But if we look at the amount of money that we received $2,170 from TSLL. We received $1,840 from ticker symbol MSTU. And we received $2,718 from ticker symbol SOXL. And that'll put us at a grand total of $6,728 received from selling puts. And if we recall back, the Super Bowl ticket cost $6,603. So boom. There we go. I'm going to go tell the wife that I made over $6,600 extra and that the stock market has paid for my Super Bowl ticket, so I'm going. But there you have it. If you would like to learn more from me, come join the Trade to Freedom community. Not only will you get my actual trades as soon as I enter them, you'll also get my entire options framework via the Trade to Freedom course. And lastly, you'll be within a community of other traders from beginners to experts that all have the exact same goal as you. But that's it for this video. Make sure you like and subscribe, and I'll be sure to see you at the next one. Peace.